Tonight we're going to kind of be talking about an options chain. I'm actually going to use TD Ameritrade's Thinkorswim platform here. Many options chains are the same though, regardless of the broker you use. But as I discuss first, just kind of setting up some basic stuff on that options chain, it'll be in reference to TD Ameritrade's Thinkorswim. When you go to the trade tab on your main build screen for Thinkorswim and type in a ticker symbol, you'll get some other stuff that pops up, but this here will be the look of the options chain. And you'll see here there's different expirations or different weeks to choose from. To make things really, really simple when you're using Thinkorswim, the yellow ones are weeklies, the gray ones are monthlies. If you go back and watch past videos where I talked about it, you'd actually hear me say the red are weeklies. They changed it. They changed it so that I would look like a liar. Anywho, gray ones, weeklies, yellow ones are, or sorry, yellow ones, weeklies, gray ones, monthlies. Now, when we go to look at the options chain, one thing I have found is people will click on one, and we're just going to go to the December monthly here. And if they see an alert from me, that alert might say something like SPY 1218. I'm just going to say like 206 puts, right? That would be the alert. Well, here on my options chain, you don't see anything that says 1218. Now you could look at accounts or a calendar and go with just Fridays. And you know, up until the start of 2015, the monthlies always expired on a Saturday. They actually changed that and made it so that they all expired on Fridays in January of 2015, with the exception of the index quarterlies. Anyway, up on this screen right here, this tab says Layout. If you click that and go to Customize, if you're one that has a difficult time with the dates I put out, scroll down and find where it says Options Code. So I'm actually going to remove some other stuff that you see on here real quick. I'm going to go to just that options code. Now, the cool thing here is if you look right here where it says option code, you see where it says like this very first one, SPY 151219 C 203.5. Does everybody see that on the very first line here? Did you know that if you type that in to a chart, period, SPY 15, meaning the year 2015, 12 for the month of December, 18 for the expiration day, call 203.5. It doesn't, you don't need the 0, it's just the 0.5. Actually, it's 19. That's weird. TD Ameritrade still has them for this one in particular, expiring on the Saturday. So anyway, this will allow you to chart the actual option. Now, when you chart an option like this, people would commonly refer to this as a put call chart. And it allows you to chart the actual price moves of the option on a time frame. This chart just happens to be a 15-minute chart. Now, the breakdown of those aspects of it, you have to start with the period. That's just what they require for TD Ameritrade. The SPY, well, that's the ticker symbol for the stock that you're looking at. That 15, again, that's the year. The 12 is the month. The 18 was the expiration. Here they got the 19. I do a lot of my trading from E-Trade, so it says December 18th, so that's why I alert it that way. But that's a way that you can look at it. Nonetheless, if you struggle, like if you're using TD Ameritrade Again, if you use E-Trade, it actually gives you the expiration date on a tab for it. But if you struggle and are using TD Ameritrade with seeing maybe like an alert I put out and then trying to figure out which one that is, add the option code to your option chain. Now, the other parts I have up here right now is the bid, the ask. That's no different than if you were looking like for a stock. The bid, what is that? That's what somebody's willing to pay, right? And the ask, that's what somebody's trying to sell it for. This last X that's over here, that's just the last trade that was made. So you see like that 203.50 call, the bid's 425, the ask is 434, but the last trade was 431. Now we're going to go back up here to this layout thing and over here to customize. I'm going to take off the option code because again, that's just something, if you're one that needs the option code, that you're more than welcome to use that. And we're going to go through an explanation of a couple of the items here. The first one I'm going to add is the delta. Now, if you watch an options chain while you're actually trading during the day while the market's open, you will see that delta constantly changing. If you sat and stared at it, it would surely change and change again and change again and change again. I personally am one that defines it slightly different than most would. It's simply the projected or estimated profit or loss that would be seen on your particular contract if the stock moves $1. So really quick, have you ever been listening to me talk and heard me say something like, I think that if you wait for this to happen, you could buy those at this price, and at this target, I think you'd sell them for this? Or something along the lines of, hey, I'm entering a conditional order. Stock XYZ goes above this. I want to buy this, and here's the limit price. Have you ever wondered where I get those prices from? Anybody ever wondered that? Some of you've asked before, so you might not wonder now because you've asked and I've told you. But if I was entering a conditional order per se, the one thing that Delta will not do is help me figure out a price for something multiple days later, which means it doesn't give me any factoring of the time decay, which we'll talk about that in a moment. But I'm going to bring a chart over here real quick. We're going to look at a SPY chart. Now, on this chart in particular, there's a way we can actually look to see how accurate we might be. Now, first off, I want to look at this as a bit like if we were doing a conditional order, okay? Now, what do you see kind of just glaring in your face of if it fails this, we've got a very clear, defined pattern. I mean, right away, people are probably going to say, that looks like an M. No, it looks like a double top that pulled back. Where would it look like an M? Or where would it actually be an M? Anybody? Hint? More hints? Yeah, if it failed that center. Now I got to delete all those hints. Now, one thing I've found is there's a lot of times where you'll sit and study charts. I'm sure everybody does that. And you tell yourself, man, if this stock does this, whatever this is, I think it could go there. And you sit and watch it that next day, and well, guess what? It's probably not going to do it just because you're watching it. And then you go back a month later and you're like, oh man, it did exactly what I thought it would. You ever been in that situation before? I know I have. So, real simple, if I wanted to make sure that I could get filled on something, or that, I didn't miss it because I really wanted to make the trade, I could use a conditional order, and we'll talk about conditional orders another time, but we're going to talk about something just relevant to the use of the delta. And it would be quite simple. If we use that closing value, 202.54, and we grabbed a handy dandy calculator and said, you know what, the current price is 206.95, and we were looking for a 202.54 failure, that's $4.41. Now, to keep things really, really simplistic and easy, if we were going to say buy the 200 puts on said failure, I just had to expand that to all. That's why that did that. But we would come over here, and there, the 200 puts are the one I have highlighted. And we could look at our delta column here, the one on the far right. And if we multiplied that by 0.19 and then added that to the ask price, there's a reason I add it to the ask price. Quite simply, the ask price right now is what somebody's willing to sell it for. Well, if I want to make sure I can actually get filled, I have to buy the ask price. Otherwise, I just might get filled, right? So I'll add that to that 92 cents, and then I always round up. So I would enter a conditional order if I was using that for this trade at $1.76 as my buy price, even though they're 92 cents right now. If I was insistent that I needed to wait for a certain thing to happen, I would expect that those contracts would be $1.76 is what I'd have to buy them for. Now, if I use the delta, which to find out where your option price would be is fairly simple. It's the difference between your current price and your target multiplied by that delta. And this will actually give you a very, very close and accurate rough estimate. I say that because, you put that order in today and then tomorrow happens, well, you might have to refactor it a few times. There are times where, I'll put in a conditional order, and by the time it hits 3 weeks later, 4 weeks later, sometimes even further out than that, the price of that contract has severely changed due to the time decay. But a lot of times when we do conditionals, so long as that conditional hits, in a couple days, within a couple days, you'll actually find that the price that you are putting in for gets you filled. Now, there's another way that I'm going to talk about here, and I'm going to move this options chain down a little bit. And it would be in using that delta to help figure out a little bit of a projected sell price once you're in it. Here I've got the SPY on a 15-minute chart, okay? And we know today that basically and did a little something something, but really the end result was it ran up, it hit, it double topped, and it double bottomed, right? It defined a consolidation range, didn't it? Now let's just assume, and I'll have to move this chart. Oops. Let's just assume that I wanted to trade the calls because, hey, it bounced off of this line again. It's already double topped. I think it'll go back to that top point. And, the value of that line is 207.68. If I was looking at trading something with the same week expiration to do a day trade, I would want to make sure I was trading something that would be in the money at the time it hit that line. So basically, I would be able to choose the 207 call or the 207.50. With that, let's use the 207.50 call right here, the one that's sitting 86 by 87 with a delta of 0.42. And somebody tell me that if my target sell price, my target point on the stock itself was 207.68, what would my expected sell price be for the 207.50 call at the time that it hit 207.68? Anybody, anybody? Just a moment ago, I talked about how if I'm projecting using the delta for a buy, first off, I was using which between the bid and the ask to establish where I could buy it at. The ask, right? Because I want to make sure I get filled. Well, if I'm trying to sell something, what's the only way I can really guarantee I'll be able to sell it? To sell it on the bid, what somebody's willing to pay. So my estimate would be $1.16. And where I'd use this is basically to say, if you didn't want to do a conditional order, you could do something along the lines of a limit order where you said, I don't want to get emotional. I don't want to think otherwise. When it gets to that point, I just want to sell those. If it breaks that point, I'll buy something else. So what limit order do I set in just to get that 207.68? And I would say $1.16. And I'm going to show you how I came up with the $1.16. First, I take 207.68, target price. I subtract current price, 206.96. That gives me 72 cents. If I multiply that by my delta of 0.42, that tells me basically to add 30 cents to the bid of 86. And while I round up when I'm looking to buy, I round down when I'm looking to sell. Why do I do that? Well, I want to make sure I can buy and I want to make sure I can sell. So if it came up with this answer and I was trying to buy, I'd say 117. But for the sell, 116. Now, if we were actually to look at the point in time about 2 o'clock today, where this week's 207.50 calls went up and hit exactly 207.68, we could type in SPY 151211 C 207.5. and we can run here right at 2 o'clock, and we see they hit a high of 138 at that time. The low off of this area was 114 off of that candle. Now, one thing to also point out, do you notice how we talked about a double top on that SPY chart? We had talked about a double top, but do you see on my call chart where it was not even close to top? It was like quite literally a lower high, and then where we had the double bottom, we actually got a lower low. That's a little bit of that time decay factoring in, okay? If you're channeling horizontal on a stock, don't think that just because the last time a contract ran from 20 cents to 40 cents, that the next time bouncing off the exact same price and going up to the exact same price will also go 20 cents to 40 cents. You actually decline in your prices. So if it was a buy at 20 cents and a sell at 40 cents before, it might be a buy at 17 cents and a sell at 34 cents based on the time decay. But to get a general idea of your expectation, even when you might be trading in real time, that is how I personally use the delta during the day, especially on day trades, to determine one thing, really. Now, at one point in time towards the end of the day, I kind of talked about a few things that I was looking at that might make some moves, but how I really didn't feel that they were worth trading. You hear me a lot of times talk about the delta and how it's the projected profit or loss that a contract will make if the stock moves $1. With that being said, the thing we really have to realize with that is when it comes to the Greeks, the delta that everything's really in relation to something moving $1. And that's why I'll also say many, many times that options is a game of $1 moves. Now, when I look at that and I look at the fact that the delta's telling me that that up move is going to get me 30 cents of profit, and I'd have to pay 87 cents for it. If I take on my calculator and type in 30 divided by 87 and multiply by 100, that would be the percentage gain. One way that I've personally been taught to simplify trading in general, and it wouldn't be reading a big long synopsis on irrelevant stuff. I'm one that when it comes to the Greeks can be so confusing to people that a lot of times they just end up messing themselves up further. But for me, and just taking it as a general approach, because the values are constantly changing, and because they're constantly changing, there's no constant in it, and therefore the calculations are going to be skewed always. So when you look at getting just a estimate, and you estimate something being a 34.5% win, then what you run into is a very simple approach personally I take on all my options. I look at the risk of any options trade period to be 50%. Why? Because I've gone to the bathroom before, seen one candle go the opposite direction, and been down 50%. That's not hard, especially when it comes to day trading. So when it comes to getting an idea of that and factoring things like risk and reward, for me, I also have to look at it as, are there times that are going to come up that aren't worth trading even if I'm right on the move that it makes? And plain and simple, when I look at something that's 34% gain, now you might say, hey, that's a really nice gain. For options, it's really not. that's really not that nice of a gain for options. And those are the times that it can actually get you to the point where you start to struggle on your trades because, one quick support failure when you're just trading in a tight range, and now you have to have 2 or 3 winners to make up for that loser. The other thing that happens as well is when it does get up there, you don't sell it anyway because you start to think, well, it could break up, and then all of a sudden you're back down here, and the longer that's trading in that consolidation range, the less you get for it. So when I use that delta for intraday stuff, really I'm just trying to determine if it's even worth me trading. To get a projected sell price to see if it's even worth me trading. I'm more reliant on the delta for using conditional orders for buys on my swing trades. It makes it really, really simple, and it's quite accurate. I mean, the after hours group that we do, every trade we make is through a conditional order. And we get our fills, we do just fine, and it's based off of factoring in that delta's value. So the delta, don't overthink it. Don't waste your time trying to overthink it. All you do is take the difference in price right now to your projected price point, target, whatever you want to call it, multiply it by that delta, and that will tell you what you would be expecting to gain on that particular contract. If you try to make it more complicated than that, you're probably actually going to confuse yourself more on things. There's a lot of information out there with trading that's quite irrelevant, if you ask me. And it confuses people more than it helps them. The next thing about the option chain, we can go through the questions and such. We'll go through that in just a bit. So just write down your question and we'll go through it. I'm going to go back over here to the options chain. And we're going to add the Theta. Theta is that common monster people call time decay. Basically, what this is doing is telling you what your option's going to lose holding it overnight. Now, if I come down here to like January 2017, you're going to see my Theta super, super small, 2 cents. And that's 2 cents off a $12.50 option. I come up here and it's, if I'm looking at the 206 puts for this week, it's 17 cents off a $1.08 option. In fact, 17 divided by 108, that's a 15.75% drop. Now, where could I expect to see that most visibly? People get told sometimes that the Theta is their time decay. That's what they'll lose overnight. And then their stock gaps in their direction, and they're like, oh, I didn't lose anything overnight. A good example would actually be those Apple 116 puts that I sold half of yesterday but held today. Apple gapped down today, didn't it? It gapped down even lower than what the price was yesterday when I bought those. But initially at the open, it was only like 5 cents higher than what I bought them for. Now, as it traded down to the low in that first 15-minute period, they were higher. But that was one aspect of, wow, we gapped 30, 40 cents, and my contract really didn't move. So where you'd see this is if your stock opened at the same price. If tomorrow the SPY opened at 206.95, you would see a contract that was trading at $1.08, trading 15.75% lower, basically losing 17 cents. On some stocks, some of your bigger name and higher volume stocks, and Apple and Netflix and Amazon, you can actually apply a much more simple rule to understanding the time decay aspect. And it's just through the days of the week. 1/5, 1/4, 1/3, and 1/2. Meaning, if you hold that stock overnight on Monday, you're going to lose 20% of the value of that option overnight. If you were to hold that stock overnight on Tuesday, you're going to lose 25%. If you hold it overnight on Wednesday, you're probably going to lose like 33%. And if you hold it overnight on Thursday, you're probably going to lose 50% into Friday morning. And where can that be helpful? Where that's most helpful is when somebody says, yeah, I'm holding that to see if it comes back. Because first off, let's face it, if you count up the number of times you held something to see if it comes back, especially for a day trade, something that expires in that same week, and counted up how many times they actually came back to the times they didn't come back, you would already find enough reason to not hold and see if it comes back. You'd already have enough reason for that, because the times that screwed you would not be made up for by the times that didn't. The other place in finding whether it could even be worth holding a contract overnight that expires, especially in that same week, is in figuring out how far something might have to gap upwards or downwards for you to break even. And again, there's a very, very simple formula for that. Theta divided by delta. And if you watch this at the end of the day, every day, and into the next morning, you'll see that this is really, really accurate. Very, very accurate on a day-to-day basis. So for that 206 put we were talking about that had the 17-cent theta, it's also got a 40-cent delta. And if I were to hold the 206 puts overnight tonight into tomorrow, what I would be looking at is needing a 42.5-cent gap down on the SPY in the morning for them to open at the same price they closed at today. Now let's think about something for a second. There's only three directions, or there's only three things a stock can do at tomorrow's open in relation to today's close, right? It can gap up, it can gap down, or it can open at the same price. Aren't those the three things that can happen? And if you really think about that, it's either going to be at the same price, it's going to be higher, or it's going to be lower. And if we were to apply our redneck math to that, that means each one of those options has what percentage chance of happening? 33.33%, because you can only go up, down, or sideways. Can't go backwards. So first off, if you're looking at right off the get-go, only having a small chance that it will gap in your direction, and then you start to find that you have a large gap that would be needed, you might then also want to find yourself exiting with the plan to buy again in the morning. Now, one way that I would look at that is if I need a 42.5 cent gap down to break even tomorrow, if I closed at 206.96 and I need minus 0.425, so 206.53, where is my support at? There's a reason I would ask myself, where's my support at? Can anybody think of the reason I would ask that question to myself? What assumptions do I tell you to always make with your trades? Support will hold and resistance won't be broken. And stocks do not need a reason to trade up and down between support and resistance. It's usually a reason that makes them break resistance or fail support. So if my support, as I'm looking at it here, would only be a 20-cent gap down because it double bottomed off of that, it held before, it might hold again. I would want to make sure that if stocks don't need a reason to trade between support and resistance, that what I needed for the gap was above my support for a gap down or below my resistance for a gap up. Otherwise, it may not even be worth holding at all. Because it's one thing to get a gap, it's another thing to get a gap that fails support. And what do you almost always see if you do get a gap that fails support? What do you nearly always see if you get a gap that fails support? Let's think about this in terms of Apple today. We got a gap below a support level. Gap down to here. And what did it do immediately on that first candle? Went right back up to the failed support. That happens a lot. Happens even on our daily charts, like with CVX today. We got our support failure yesterday, but then we gapped today and retested that failed support. So let's kind of think about that. If I'm looking for a gap or needing a gap just to break even for that next day, making sure that that gap is still above my support or below my resistance means that there would be money made if it gapped beyond my support or beyond my resistance. The other thing I would need to look at is if I did hold that and say tomorrow it gapped below my support, but my support was within what I needed to still be at the even point, what would I want to look at doing with that overnight hold during that first candle's period? If I hold puts overnight and I get a gap down, sometimes you get a gap and run, as they call it, and sometimes you get a gap and retest. The gap and retest is actually more likely to happen if the gap fails a support level. It's not always necessarily a fill the gap, but many, many times you will at least retest the closest support that was failed on a gap. So when we look at that, we would want to make the plan to sell early. If this was the gap below 206, we would want to sell and then be watching 206 for another buy possibility. If it gapped down here to 206.30 and we had profit, we may want to sell and look for the retest of our support level here. And to figure out what we could sell for, we could again use that delta. Now, The other thing also that I use that little simple math for, the theta divided by the delta. When do you think is a time that people really like to trade options because they think a stock is going to gap in one direction or another, that it would be important to know how big of a gap is needed to break even? Earnings. There's a lot of times you'll hear me, somebody will come in and is like, Facebook has earnings and I think it'll gap a whole lot, and what should I play? Or like the other day, somebody's asking about AMBA. And I say, well, this thing's priced to have, you need a $4 gap. You'll actually find that many times the day before earnings on your weeklies, the theta is higher than the delta, which means when you divide theta by delta, you're going to get a number above 1, right? That gives you an idea right away on how far something needs to go for you to actually break even, to see if it's even worth it. Many times you'll actually find for earnings that some of those more popular stocks are priced, their options are priced to the first support or resistance level on a daily chart. In which case, you'd almost be better off to see if it breaks the resistance the next day and trade it as a momentum trade. Really, really simple. So I've talked about the delta. So far, we've talked about the theta. The next thing I'm going to add to my options chain, we're going to add two different things at once here. We're going to add the open interest, and we're going to add the volume. The reason I'm adding both of these is they go hand in hand. In most cases, your open interest number will be higher than your volume number. The open interest is actually volume. It's the total volume that contract has traded. The volume is the number of contracts traded that day. Tomorrow morning, if you look right at open, these will all be 0 in your volume column. And these, tomorrow morning, on the open interest column, will be the open interest number plus the volume number. Where can that be important for us? Where can those two columns come in really handy to us? The big thing I'd say would be in your position size. Whether you're somebody that goes with more conservative approaches like a Warren Buffett that says, no matter how much I want to buy of a stock, I'll never buy more than 8% of its average daily volume. It might take him a month to buy all the shares he wants, but he'll never buy in a single day more than 8% of that stock's average daily volume. Okay. Some people, you go to like penny stock chat rooms and stuff, and they'll tell you no matter what the stock is, never buy more than 20% of the average daily volume. I always thought that was a bit excessive. But if your average daily volume is sitting around 20,000 contracts and you go and buy 70,000 contracts, you better be really, really sure that you're going to have some intrinsic value on those options, or you might not have anybody to sell them to. The open interest, where I use that, and I actually use that more than the volume, but I use it in a simple correlation. You know, some people get all worked up when they might just see a single burst of volume in some contracts. They get their panties in a knot because they think that means they should follow it. What they really fail to realize is most, probably closer to 85, 90% of options trading that actually happens is leveraging, meaning you follow the big buys, it's actually going to go the other way. They are leveraging because they think it's going to change directions. And they'll leverage stock ownership with options, okay? But where it can also get really, really funky is when you find a time where your volume for a single day matches or exceeds a particular open interest. I really like when it exceeds it by something I can get a multiple on. For instance, when I look at this week's 206 puts, I can do some redneck math real quick and say, wow, today that thing nearly traded double what it's traded since its inception. 40,000 contracts today, just shy of 27,000 contracts every day it's even existed before today. When I come over and look at the call side, I see, wow, the 208 traded almost as many as the 206 did, and I'm sitting right around 207. Now, I don't have to be a very smart man to think of what might be happening there. Let's go back and talk about something you got Sunday night. Even though it was late Sunday night, you might not have got it till Monday morning, the market overview video. We talked about maybe having some volatility throughout the week, but until we get a decision from the Fed, we might not make any moves from just these doji candles we're putting in. Is it possible that, now at first you might say that just looks like somebody strangled 208 calls and 206 puts? Yeah, that's possible. Where that would be more common is if they were doing a spread to trade in between those two numbers by Friday's expiration. Now, if I start to find where one side is lopsided, the put side is really, really lopsided compared to the call side, that doesn't mean I take the approach of saying, oh, it looks like the whole world thinks this thing's going down, or the call side's 3 times heavier in trading than the put side. The whole world thinks it's going to go up. I look at two things on the chart first. If my put side is heavier in volume, I look to see, did we fail a support, or are we just coming into a support, maybe hit the support, or did we pull back from resistance, okay? Here's why I would look at that. If we're looking at the puts and a stock hit support and didn't fail below it, volume isn't just buys, is it? Couldn't volume also be the sells? I mean, somebody had to buy them for them to even register as a transaction. But every buy is a sell. Every sell is also a buy. And it could have been a large number of people going, I think it's going to bounce. So I sold my puts. So if we're at a support or pulling back from a resistance and the volume number went up, I expect that pulling back from a resistance, you get more buys on puts, and at a support, you get more sells. If I look at that chart and it's, wow, we failed support, that's more buys again. On the call side, if you hit resistance and had a high volume in this particular contract, they probably sold it. If you made a positive move from support or broke resistance with high options volume, you either had buys on the break of the resistance or buys on the bounce from support. And I want to follow the likely buy scenario. The likely scenario of buys. So the volume and open interest, again, they work hand in hand, but the open interest is all the contracts traded prior to today, and the volume is what's traded today. So if you were to look at any of those contracts tomorrow, you would see that they would equal, the open interest would equal today's open interest plus today's volume, and your volume would be back down at 0 to start the day. So when you look at those two things, make sure you know what it is you're actually looking at, because many times, and I've seen this through people even sending me private messages, people might only look at the open interest and say, this thing's not even trading today. Why are you buying it? That number's not going to change all day, no matter how much it trades. Or somebody looks at the volume at 9:32 in the morning and says, this thing's not even trading. Why would you buy that on something like an Apple that might have a very high open interest? So volume, open interest, they go hand in hand, and they both relate to the number of contracts that have been traded. Now for like the basic starter pack of starting out with an options chain, this to me is all you need. You can further confuse yourself by adding all those other things that are selectable. You could add the gamma, and I could explain how, well, you know, the delta is the projected first dollar move, and then you add the gamma for each dollar after that. And then all of a sudden you're sitting here going, I have 17 pages of notes for one formula to use this stuff. And it can get confusing. If you want to start out with an options chain that will help you get the data you need to be able to plan a little bit on options prices, and put you in a very, very good situation as to approaching your options trading.